Welcome everyone, and welcome Clemens. Thank you for being with us today and share your views on the markets and the economy in such uncertain and strange times. Welcome, Clemens.
Thank you. Great to be here. Thank you.
All right, Clemens. So you've been in finance basically a lifetime as a financial professional, now an academic. You've been researching markets for decades. Have you ever encountered such a disconnect between Main Street and Wall Street?
No, to be honest, and yeah, the short answer is no. And if you look at this disconnect between the market and what some people would call the eye test, what you see when you go out on the street and everything is closed, I've never seen anything like it. So the broader economy, at least for the eye test, looks very different from what we've seen in Wall Street since the lows in March of this year. And aside from the massive stimulus that may explain this, I have a couple of thoughts as to what that disconnect could be the result of. And I'll come back to that in a minute. So in terms of the rates, I think we're in this weird position now where I literally think there's a greater than 0% chance that we have to rewrite finance books and rethink how finance is looked at entirely. And to reference that, so I looked at a recent article by some researchers at the Bank of England, and they did an in-depth study of some 8 centuries of interest rates with really phenomenal charts and everything, and even more controversial insights. And they basically depict a long-term downtrend in rates despite of the occasional interruptions that we've seen in periods of high inflation, going back to the early 1920s and 1970s. But if you look at this latest episode of the downtrend in interest rates in the US since 1980, in the really long-term perspective, this is really just a minuscule episode of an otherwise vast long-term trend. And if you go back really, really way before that, I recall somehow that there was this famous Code of Hammurabi, 750 BC, which talked about interest rates for lending, and anything that was considered usury was in the 33% or 1/3 range. So if we're looking at interest rates back then, 33% all the way to 0, so there's a possibility that we all have to relearn finance, as weird as it sounds. Now, in terms of the medium term, you probably are aware or familiar with the Fed Watch tool, which depicts sort of a probabilistic approach of how rates will look like on the short end of the curve. And I've never seen anything like it. So more than 6 months out, they project 100% probability that will be at the zero bound.
Well, isn't that perhaps because the Fed has been quite vocal in saying that there will be really no interest increase for, as far as I can see. So they're just playing off those words.
Absolutely. But I don't recall ever seeing 100% probability of this happening. I've seen 90, 95%, 6 months out, but 9 months out, 100% probability is unprecedented. And it clearly shows the Fed's there. Whatever it takes is the notion. Don't fight the Fed is all I can think of at the moment.
That's right.
Right. In terms of the valuation models, I think it all depends on the discount rate at the end, right? So we can project whatever growth, whatever cash flows we may think of. If you're thinking of a discount rate that goes lower and lower and lower, close to the zero bound, you can have any type of valuation. I'm not comfortable with it. I'm not comfortable with some of the valuations, but again, it goes back to this notion of don't fight the Fed.
Right, and that's the point I've been making lately, is that with your discount rate at 0, then $1 that is produced 10 years from now obviously has a major impact on today's fair value, as opposed to discounting that dollar at, say, 5%. So that really makes, the mathematics of the DCF model really works that way, and then there's a huge change for small change in the discount rate.
Yeah, absolutely. In terms of the allocations, I'm not comfortable with the fact that we have some zombie companies now that are basically held on life support indefinitely. And what makes me kind of shiver is the fact that more and more of the pension funds are kind of forced into buying these junk bonds now, as did the Fed, obviously. So that's, again, unprecedented territory where...
Even though that's an interesting point, because the Fed did say that they were going to buy, of course, and they did. In fact, they went on and bought ETFs that represent
Right.
indices for corporate bonds. They said they were going to buy also directly. But then when you actually look at the makeup of the balance sheet, actually what they did is very small compared to what they could do. Is that because the jawboning, so to speak, has actually worked? The threat of doing it has calmed the markets without them actually having to do it, or is it just that maybe this is just the beginning, and then we're just going to see this, sort of developing over a much longer period of time?
Yeah. So I firmly believe in the notion of signaling. So the Fed signaled to the market, this is what we're going to do, and they probably could have done the same effect with even less purchases, but just the fact that they said this is what we're going to do, and then they follow up, however minuscule the action might have been, actually, I still think it's the signaling that had the effect of lifting up the junk bond market and everything else with it. So was it necessary? I don't know. I mean, as still an advocate of somewhat free markets, I'm not comfortable with the fact that there are some companies that basically aren't allowed to fail. Because I think that a big function of the market is to find out the goodies from the baddies, in a way, right? Finding out true valuations through free markets is an important function of the market. And if we intervene too much, we're not being competitive in the long run. The last part of the question was about retail. Obviously, you and I have seen this before in the 90s. It was a different time then, but in a way, the rebirth of the day trader, if you will, that we've seen with the likes of Robin Hood. All I can remember, it did not end well for the retail trader. It ended well for some, a minuscule minority of them, but overall, it did not end well, because the notion was that everything just keeps on going up. There's no limit. And as a trader, I feel like every time when markets go parabolic, when the exponential increase is almost vertical, then we go into territory where I'm not comfortable with.
Right, and if anything, I think that day trading, it's even more difficult now than it was back then. The increases in technology, high frequency trading has just eroded the ability of the smaller guys or gals to really sort of arbitrage some kind of a small anomaly. So it's definitely probably a train wreck right there. I will tend to agree. But going back to the really large amount of liquidity that's being injected into the system by all central banks. Of course, we do the biggest share because we're the largest market. But would that, I would think that will have some major impact on the US dollar, that being the global reserve available. What can we expect in the currency market, and specifically on the relative value of the dollar?
Yeah, good question, and equally complicated to really answer this and make a good projection. But I think overall, this consistent deficit spending would really cause any currency to depreciate over time. And so if you look at the dilution in the value of fiat money in general, because of trillions of additional monetary stimulus, it would normally be the same for the dollar, you'd think. But again, these are unprecedented times. And maybe I can just make a quick detour to answer the question. So in the past few months, I've been asked by so many people, should we buy gold? Should we buy something like Bitcoin as a digital alternative to gold? Because everybody fears the the loss of value in the dollar with all this stimulus spending. And my answer is typically, so as a buy and hold investor, if you think of gold as an inflation hedge, it really has a mixed record historically. So there are periods of time when gold is really a good inflation hedge and periods of time when it isn't. So think of the 90s again, for example. Gold was really not a good inflation hedge. It just really almost downtrended, gradually. And if you look at the more recent times, gold also did not hold up in terms of the safe haven status, if you will, because in March, gold was at about 1,700, and it went down to 1,450, which is not as bad as the S&P, of course, but it's clearly a positive correlation, at least for some time with the S&P. Of course, Bitcoin was even worse. Bitcoin was over 10,000 back in February, and it fell to just under 4,000, I think, in mid-March. So in that sense, neither one of these assets held up the notion of a safe haven status or some sort of hedge against the risk of a downtrend in the market. And the only place that you could hide in was treasuries, and that explains, the 10-year at, was it a little over 0.5%?
Right.
So I took this kind of detour to explain or, share a rationale why the dollar is probably going to hold up reasonably well, despite all the deficits, despite this huge mountain of debt that we're sitting on, because there's really no alternative to the greenback when you think about it. Maybe the Swiss franc, but the Swiss franc is, limited capital markets over there, plus a negative yield 10 years out. And so in terms of the depth and the liquidity of the US market, it pales in comparison. And then what else is there? The euro.
Well, to this extent, I was going to say there's one thing that perhaps might be a little bit of a positive out of this mess is that it might have pushed the European Union to issue a common bond, the European Central Bank backed by the states, the governments. Could that be the beginning of some serious rivalry by the euro common currency to the dollar as a global reserve currency with a deep enough, broad enough market?
Yes, possibly, but my concerns are not necessarily founded in the economic side of things, but more the socio-political side of things. Because even though the Europeans are seemingly better off right now, they seem to have at least conquered this pandemic somewhat. But I feel like it also exposed the strains when if you remember when Italy had their problems and Spain had their problems, immediately the borders came up again. Right. And in terms of signaling, it actually showed more of a discord between the various countries in the Union. So I think the jury is not out yet whether or not the European Union and the euro have a future as an alternative to the US dollar. And just like you said, they have negative rates over there. So in terms of incentives of investing as an international investor in the euro, in European sort of capital markets, I have my doubts, at least in the medium term, that there will be a challenge to the US dollar. China, obviously, not a freely convertible currency. There's, it's no way that large investors would do that. And then what's left, perhaps the Australian dollar, New Zealand dollar, but again, they're not liquid and deep enough to be attractive for large investors and institutions. So what's left is really US currency and US denominated investments, treasuries. And in terms of the inflation hedge, then US equities, right? You have it right there. I mean, as a European myself and like you, we tend to hope that Europeans get their act together and find a way to have this alternative to the dollar as a,
As we joke so many times, Europeans always they will do the right thing after they exhausted every single wrong thing, and then eventually they'll do the right thing.
Right.
So we'll see if they can get there. But let me conclude with one question. I know you're doing some very exciting research at the moment, and you're doing research on the S&P 500 index and its composition. Now it's changing. Why don't you share some of your inputs on that?
Great, sure. So we've been looking at all of these violent swings to the upside recently, and we thought, well, again, the eye test looks different. The eye test tells us this is an economy that's really struggling still, and it's going to take a while until we get back to whatever normal is. So we were thinking, so what else can explain this disconnect between the market and what we see in the economy? And so for our purposes, we thought that what we are seeing right now is really a continuation of a trend that started probably more than a decade ago, which is really the digitization of our lives. Not just online emails and all that stuff, but everything else being physical, including watching soccer, watching football. It's all in this environment that is less touchy-feely, it's less physical, it's more digitized. And so we looked at the composition in the indexes, specifically the S&P and the NASDAQ 100 for the past 2 years. And it's obvious that the major indexes are really dominated by the mega caps, the so-called notion of FANGMANs, the Facebooks, the Apples, the Netflix, Google, Microsoft, who did I miss? Amazon. And so that is a huge part of these indexes. And so we were thinking that is there a potential that some sort of an antitrust metric could be applied here in terms of quantifying what the impact is or the domination of these individual names. And so there is actually the so-called Herfindahl index, which is used in antitrust cases to really help assess whether a company has monopoly power or not. And so we're using actually a derivation of that Herfindahl index to quantitatively assess the effective number of constituents in an index. So if you take the Dow, for example, the Dow has 30 component stocks, and based on our calculations, the effective number of stocks in that index are actually 22. And that can be explained because it's really a price-weighted index, not a market cap-weighted index. Very different story with the S&P. So at the beginning of 2011, there were effectively 131 constituents in the S&P 500. So instead of having 500, seemingly effective components, it's actually only just 131 because of the weights in the index. In April of this year, the effective number is only 80. So that means over 400 components of that index are kind of irrelevant, right? And so it's not just the top 10 companies. And by the way, the top 10 companies in the S&P are about 27% of the index weight. In the NASDAQ 100, the top 10 are 56%
right.
of the index weight. It's not an index anymore. It's really a handful of or two handful of stocks really that dominate everything. So we're seeing some concerns in the way these indexes are measured and the component weights are determined by the index, S&P or the NASDAQ. And that is a problem going forward because most people, retail investors that are conservative, passive investors, assume, hey, I have a great diversification, I have a spread of 500 companies. But based on our measure, it's actually just effectively 80 companies that really determine the fortunes or misfortunes of the index. And so that's a cause of concern. But at the same time, it explains why we see this disconnect between what the market shows us and what perhaps the real economy is shown at the moment.
And also what the US market shows compared to international markets that have not gone up, as much as we have for the last few years, because they have a much more, broad and different and a little bit more cyclical structure than we have. So that's certainly true.
And it also shows in the performance year to date. I think the NASDAQ is up about 20. I didn't check what it is as based on today, but I think as of Friday it was up almost 20%. It's new high today, so it's probably a little bit above that. The S&P is kind of more or less breaking even, almost breaking even right now. But then if you look at the Dow and the Russell, they're still lagging behind year to date. So again, kind of the composition of these indexes and how the weights are, determined by the S&P are partly explaining this disconnect, I think.
Very well. Listen, Clemens, this is all we have for today. I want to thank you for taking the time and sharing your knowledge with us. Our community will greatly appreciate it. And I look forward to seeing you again on campus at some point when we get back.
Likewise. Thank you, David.
All right. Thank you very much.
All the best.